Greetings and happy Friday. Chris Griffith here, managing partner, co-founder here at Stablepoint Partners. And today is actually Wednesday, August 13th, and hopefully you're receiving this on Friday, August 15th. But wanted to share with you, as we try to do every week, our thoughts around the markets, the economy, and things that are impacting you in the world at large. So I want to dive into a couple of topics this week. Really front and center for us are two things. Number one is a very optimistic inflation report that came out on Tuesday that's worth talking about. And number two is really getting into the weeds a little bit on some of the details that we're starting to see with the second quarter corporate earnings reports that are coming out, and talk a little bit about the low bar that has been set across the stage there for them. So first, let's start off with Tuesday's inflation report. And data came out at a 2.7% inflation rate year over year versus an estimate of 2.8% year over year. That doesn't seem like a really big difference, but it led to a pretty big stock market surge on Tuesday. I think a lot of investors feared an inflation number that, frankly, probably had a 3 in front of it. This data really kind of puts to rest fears that we've got that inflation is starting to run away due to tariffs or other things in the economy, and really should pave the way now for the Federal Reserve, most likely at their next meeting, to start a process of cutting the Federal Reserve interest rates for investors. So this news was obviously welcomed by Wall Street. It's great for stocks, it's great for bonds, and most importantly, it's good to see inflation generally staying under control for all of us here, looking at our budgets every month and what things are costing. Number two, this is where we'll really have some fun and kind of get into the details of what we're seeing out of the second quarter corporate earnings reports for the S&P 500. And the stock market now has had a really nice recovery from the April lows. A lot of that has come here during earnings season. And I want to share with you some data why. And this is part of what we love doing and really getting into the weeds in the details of quarterly earnings reports from companies. How are they doing? How are they performing? But also, what kind of guidance are they giving us for the road ahead that they might expect? Good things, bad things. It really helps us as investors make good and informed decisions for you. So what's really happened here, mostly due to tariffs and uncertainty in the economy, is the bar has been set incredibly low. We've got very low expectations going into the second quarter's earnings reports. And for the most part, due to those low expectations, companies are doing terrific. So far through earnings seasons, 63% of the companies that have reported thus far have beaten their expectations. Meaning, if analysts expect a company to make $1 per share, they make $1.01 or more. They've beaten that expectation. And again, a big part of that were because analysts have brought those expectations down. But this is the highest percentage of companies beating expectations that we've seen in 25 years. So this is kind of a big deal here coming through the second quarter earnings. The other thing that we look closely at across the board is growth. And we saw a rate so far through earnings season of 9% year over year of earnings growth in the S&P 500. This compares to just 4% earnings growth from the analyst estimates, more than double the estimates or what companies are coming at from an earnings growth perspective. And what we really like that we see, again, in the details, is what are companies telling us as we're guiding forward here, next quarter, next year, where do they see things going? And 56% of S&P 500 companies that are reported have guided higher, meaning, and hopefully you've got a chart on your screen that you can see as well that shows how this looks today versus even a quarter ago and even the last few years. But they're saying going forward, we're guiding higher, meaning we're expecting higher earnings the next quarter, the next year, and for some companies that give us further guidance the next few years. So this is incredibly positive news, and this is the highest percentage of companies that we've seen guide higher since 2001. So again, a pretty meaningful quarter, not just for earnings, for growth, but also for forward-looking guidance as we go company by company here through the earnings. And this has really been a tale of haves versus have-nots. So the last kind of devil in the details that I'll share with you is on a stock-by-stock basis, quality versus low quality stocks in the market. We are seeing high quality stocks, the 20%, 1/5 highest quality. So those companies that have been around a while, solid balance sheet, good income statement, not a lot of debt, they're outperforming their low quality counterparts, which have more debt, higher leverage, less of a track record. significantly. And their price to earnings ratios right now are 57% higher, the high quality stocks, than the low quality stocks. And this is about as extreme of a relationship that we've seen here between the high and low quality companies in the market, going back 30 years to 1995. So it tells us that investors are still worried about tariffs. You want to own businesses that aren't over leveraged, that have a high quality balance sheet to them. But the haves and the have-nots of high quality and low quality have been a big part of this market. And some of these larger companies in the high quality bucket have really pulled the market higher, so much so that although the stock market now is back pretty much to all-time highs, your median stock in the S&P 500 is still trading today 10 to 12% below its 52-week high. So that tells us there's still opportunities out there. Markets are back to all-time highs, but there's a lot of great companies of high quality that have still got a ways to go. So it's really great what we're seeing out of these quarterly earnings reports. We continue to be cautiously optimistic. But again, with stocks, we're always looking at least 3 years or longer to take away the risk of the short-term market pullbacks and volatility. So again, in summary, really positive news this week, both out of quarterly earnings reports for corporate America, also out of the inflation data that we saw, and our expectations for the Fed and rate cuts probably moving ahead, looking even better than they were before. So with that, I'll wrap up by saying that we sent out some emails. Hopefully you saw that, and we're excited for Anne Marie, but certainly incredibly sad to be losing her after almost 20 years of working together. She will be retiring on September 1st, so lots more to come on that, but want to obviously say a word or two about a dear friend and a great partner for almost 20 years. With that, have a wonderful weekend. Have a wonderful rest of your summer. We look forward to getting together this fall and having our regular scheduled meetings to go through year-end items, big, beautiful bill impact, portfolio direction, and so on. But obviously, we're here in between. Any questions you have, reach out to us anytime. Thank you, as always, for your trust, your confidence, and advocacy. It means the world to us.